Hey friends, welcome to another episode of Josh's Corner, where I answer real estate questions for you. Today, the looming question is, are mortgage rates going up? Are interest rates coming down? How do we know? What the hell is happening? Well, I want to talk to you today about the pivot, and specifically, what is the pivot and how dangerous is the pivot for our economy? So we know that the Fed is gearing up to pivot and cut interest rates a lot sooner than what we think. This is actually going to have a massive impact on asset prices, on the economy, and inflation as a whole. When we look back at the last 50 years of recession, we see that after the Fed pivots and cuts interest rates, asset prices drop by even more. On this table, we're looking at the last 8 recessions in US history going all the way back to 1957. We're looking specifically at the month that the Feds pivoted and cut interest rates to save the economy. What we see on average in these recessions is the S&P 500 crashes a lot, and it tends to bottom out anywhere between 12 to 18 months after the Fed pivots. It is important to know that in every economic cycle, the Feds do pivot. So it's not a matter of if they're going to pivot, it's a matter of when they're going to pivot. The Feds, or Jerome Powell, is saying that they will continue to increase interest rates as long as they need to in order to tame this inflation that we're experiencing, an all-time 40-year high inflation. So as long as the inflation rate at 8% year over year is substantially above the unemployment rate, which is 3.5%, the Fed is going to continue increasing interest rates in the short term. However, I'm predicting a pivot in Fed policy toward cutting rates once the inflation comes down to around 4 or 5% year over year, and when the unemployment rate goes up to 5%. In other words, when those lines cross is when I believe the Fed is going to pivot. And I believe this is going to happen sometime early in 2023, maybe January, maybe February, could even be as early as March. The economy is going to take a visible nosedive, and that's going to be hard for the Feds to ignore. This is when the Feds will have to come off of their rate hiking and go into rate cutting, which is going to be a signal that the recession, specifically the job losses and the labor market, they're going to get a lot worse. More data I found in my research into the last 8 recessions is that when the Feds pivot, it's a signal that the labor market for the next 2 to 3 years is really going to struggle. On this table, what we're looking at again is the last 8 recessions and the date of the Fed's pivot. But instead of looking at the bottom of the S&P 500, we're now looking at the date the unemployment rate peaked in each recession. And what we see is that the unemployment rate peak occurs anywhere from 18 to 36 months after the Fed's pivot. What's shocking is that when the Feds pivot early in 2023 to cut rates, that's not going to be what saves the economy. That's going to be a signal that the economy, or the mainstream economy as a whole, is going to get a lot worse over the next, you ready, 1 to 3 years, which is why asset prices are going to go down. When people lose their jobs, they don't have as much money to put back into the economy on spending. So consumer spending goes down, businesses have to lay off more people, businesses have to shut down, their earnings go down, which means their stock prices come down. We already see the housing market impact, and obviously our housing market is very rate sensitive. So the idea floating around right now is that even though the housing crash, if you will, has started, that when the Fed cuts rates, that's going to be somehow good for the economy, that the housing market is going to rebound. Let me tell you, that's not at all what's going to happen. Looking back at 2007 and 2008, we can see the Feds pivoted in August 2007. After that pivot, home prices went down for the next 5 years from 2007 to 2012, bottoming out at about, you ready, 25% below the level they were at before the Feds pivoted. Once the consumer sentiment index gets low enough, as it is today, a record low, people and businesses are going to completely cut back spending. Another great example of this was the dot-com boom. In December of 2000, Alan Greenspan pivoted and he cut interest rates. He cut interest rates by a lot, going from 6.4% all the way down to 2%, but that did not stop the stock market from crashing. The S&P 500 proceeded to go down all the way from 1430 to 815 over the next 2 years. That was a 40% decline after the Fed pivoted. Another example of this is in the early 70s. If we take a look at the 1973 inflation recession, which has a lot of similarities to what we're seeing today, the Feds pivoted and they cut interest rates in October of 1973. Stock prices then proceeded to go down another, are you ready? 45% after that pivot. Another interesting fact about these Fed pivots in history is regarding inflation. It's amazing how common our current situation is, where inflation is higher than what we want and the Fed is rushing behind the curve to tame the inflation, which happens in pretty much every recession. Today's inflation is a little bit more extreme though. We're in our economic cycle where our inflation is completely off the charts. Regardless, we still see Feds chasing inflation, aggressively hiking interest rates, all in order to combat the inflation. This unfortunately ends up causing a bigger economic downturn, which I think is 100% inevitable at this point. It's obvious that the Feds have gone way too far in the other direction, getting too aggressive with the rate hikes. We went from 0% Fed fund rate all the way to what I'm going to predict to be 4% by the end of the year. And let me tell you, that is a crazy fast surge. Here's the kicker. These higher interest rates, they're going to have a huge economic consequence. Not so much right now, but over the next year into 2023, we're going to see the lag effect. I'm going to say that again. We're going to see the lag effect to these interest rate increases in terms of the drag effect that it's going to have on our economy. So the lag effect, we're going to see because of the drag effect. Stay with me on this. As we know, it's going to take time for businesses and people to accrue the debt that they're going to get at the higher interest rates. In fact, not a lot of businesses are going to need to refinance their debt over the next 3 to 6 months, but a lot of businesses will need to refinance their debt over the next 12 to 18 months at what? At the higher interest rates, which means that they're going to have less money to put into their bank after paying their bank, after their debt service. They're not going to be able to put money back into the economy. And this is going to be the exact same for home buyers. So even though home sales and mortgage issuance has gone way down this year, we're still projected to have at the end of 2022, 4 million newly issued mortgages at these higher rate amounts. Bottom line, this means that people are going to have less money to spend in the economy after paying their mortgage debt. This is the lag effect. The same goes for people who are buying a car. A report that I read on used cars talked about how many millions of Americans recently purchased at the higher rates, and their payments are nearly $800 a month. These interest rates are really going to significantly impact their spending ability into the economy. And of course, as more people take out debt at this higher interest rate, it's going to cause a drag effect on consumer spending overall, and it's going to lead to a ton of defaults down the road. So the question is, are we going to continue to see inflation over the next 6 to 12 months? I believe that we're seeing deflationary pressure, specifically right now in the housing market. Home prices are coming down rapidly, but maybe even more importantly, the rents are starting to go down, and the cost of rents, check this out, are roughly 1/3 of the inflation calculation. So if rents continue to go down, that's going to bring down inflation, and that's going to start to occur as the Feds aggressively hike the interest rates. I personally believe that all of this is going to end in a deflationary crash where the Fed is over tightening. They're increasing interest rates way too fast. They're taking money out of the system through quantitative tightening, all leading to a sharp deflationary shock, which in fact to me would be great for our economy. It'd give us a fresh start, and it would build for a much better foundation for all of us moving forward, where everything is just kind of a blank slate. So if you're wanting to get any more information on what the lag effect is, how the drag effect is really going to propel us, our economy next year into unknowns, how do we climb out of that? I'm always more than happy to answer any questions for you. Just feel free to reach out to me. You can call me at 209-688-5251 or text me at that same number, or you can send an email to me at josh@rogzoom.com. Either way, I would love to share any information I have with you in hopes that it can help you make a sound decision. Until next time, I'll see you soon.